Well, hello everyone, everyone on Zoom that is. We don't know where people are in the library, but welcome tonight to part 2 of our finance and investment series with Christian Weirich of Creative Capital Wealth Management. And tonight's topic is investing basics. Christian, welcome back and take it away.
Thank you very much. I'm glad to be here, and we'll have a good spirited conversation this evening. So good evening, everybody. And I'm going to sit down for this, and we'll have a straightforward conversation about some of the ideas of investing and investment basics. As Mark mentioned, my name is Christian Weirich. I'm with Creative Capital Wealth Management in Chester Springs. It is a financial service group and team, and part of what we do is we work with retired couples and business owners, a select group of them, as they're looking for guidance and support in their investments in terms of managing, protecting, and transitioning that wealth. And the conversations can be broad-based and holistic and panoramic in terms of financial planning, and also we're going to have conversations specific about how do we invest the money, and that's what we'll look at generally this evening. So the questions that we want to try to get our hands around tonight: what does all that jargon mean when we talk about the stock market and making investments in stocks and bonds, and there's a bunch of other language that we'll touch on. What are the different types of accounts so that we can have a system for ourselves to categorize this? Where do I put these investments? What investments are geared towards helping me with, I'm just looking to grow my money, I want my money to work for me, or I want my money to be dedicated to help me prepare for my retirement years, so retirement investing, or what other goals and aspirations that one might have. And then how do we decide, well, what's the right strategy, what's the right plan, what's the right approach? So as we begin that conversations, we want to make sure that we're in the right position for this, for our money. We want to make sure that as we're asking this money to be invested and to be left alone to work for us, that we're able to do that. We're in a position financially that we're making this commitment. This money is going to be dedicated and allocated towards a longer term strategy and approach that we call investing. And so before we begin this conversation, and we do this with our clients as well, is we want to make sure the other bases are covered. Last week we talked about and had a conversation on budgeting, and part of that conversation about budgeting was making sure that we've got a plan and addressing our debt, and that we are building up cash reserves and an emergency fund, etc. Well, that's part of this being prepared. Are we prepared for investing? So do you have a steady income? That's important. Do you have money left over after meeting all of your financial obligations? So you've got your budget, you're dedicating your income, and you're making those allocations and payments towards your debt obligations, rent, mortgage, credit card payments, the phone bill, the cable bill, heat, lights, food. At the end of that exercise, is there money left over? Before we invest, we also want to make a consideration, have a conversation. Are there any other life changes coming up? A job change? Are you getting married, divorced? Is there a child on the way? All of those sort of big picture life situations also have an impact on whether or not it's an appropriate time to start an investment approach. It goes back to that: have you built up that savings account? Have you built up that minimum 3 to 6 month emergency fund? Money that's in a cash account earning some sort of more than a savings account at a bank, that we're going to leave it alone. It's for a rainy day. It's for emergency car repairs. Number 5, did you do your homework before investing in anything? Have you done any research? Have you done any research about the investments? Have you done any research about who you may or may not work with in terms of a financial professional? And we'll get into that as well. Number 6 on our are we ready to have this investment strategy, do you know your risk tolerance? What does that question mean? We'll talk about that. And it's important to know if I've got money invested in the stock market or invested somewhere, and that money is exposed to risk. Being invested in the stock market, there's risk of that, we call it volatility. The more risk, there's the more volatility. If I'm picking stocks in companies that are in micro technologies, they tend to be very volatile. Am I going to be comfortable with that, or am I going to be more comfortable with an experience that is less up and down short term and will provide for a more steady income? And there's lots of investments that do that. Number 7 is, have we set realistic expectations on these investments? If we're investing in very conservative products or very conservative bonds, and the expectation is for a very steady, modest income back to us, well, if we're expecting that to double in a couple of years, that's an unrealistic expectation. We're going to be sorely disappointed. Same thing for the other side. If we're invested in a very aggressive go-go company technology, and their focus is on getting as big as they possibly can, as fast as they possibly can, and we've selected them to help support the income in our retirement years, that's also going to be very disappointing and an unrealistic expectation. The other point is, have you developed a diversified investment plan? Also a good important conversation to have. What we want to avoid is the old saying, putting all our eggs in one basket. And we'll talk about that as well. We want to have a diversification, an ability to have the experience that we have with our monies as we ask our monies to work for us, to have an experience that's not solely based on the machinations of one thing, which may or may not be performing the way we want at the moment that we want. So here's a bunch of the jargon, and we'll talk through that. So initially, the big word that we all talk about, probably you are familiar with as you're listening, is stocks. What is stocks? Stock is a piece of a company. So companies are in the world, it's capitalism, and companies will look for opportunities to gather more money to come into that company. Not only are they usually selling some kind of product, providing some kind of service, but there's also an ability for them to gather large amounts of equity to put back into the company for growing the company, updating the equipment, so they can issue stocks. It's been around for over 200 years, and prior to that. So stocks is owning a piece of a company. A bond is you making a loan, whether it's to the government, to the bank, to a company. Corporate bonds are also companies seeking capital in. If you loan us money, we'll promise to provide you with your money back at some period of time, plus some interest, some additional income for you lending us money. So that's bonds. What's a mutual fund? Mutual funds have been around since the 50s, and it's basically a packaged product. Mutual fund is taking shares of various companies, putting them in a basket, and allowing the public, us, to purchase pieces of that basket of company stocks. Now, a mutual fund can be, and has over the years become, very sophisticated and specific. It can be a collection of companies that represent the stock market, or it could be representing very large companies, medium-sized companies, very small companies, technology companies, utility companies. So the various flavors of mutual funds can become, and do become, very specific, very elaborate, very complex. There are mutual fund companies. There's lots and lots and lots of mutual fund companies, and they offer a wide variety of various themed mutual funds that are attempting to deliver on performance for a specific objective. And so, working with professionals on your own, there'll be recommendations that you'll come across. Again, goes back to diversifying, just not picking one mutual fund, but you pick several mutual funds. You're getting a diversification of exposure, trying to manage the various risks of investing money. All investments, you're going to have risk. It's just simply trying to manage that risk. Index funds, a more recent creation. Indexes are ways for us to measure the performance of the stock market in general. Dow Jones Industrial Average, Standard & Poor's 500, the NASDAQ. There's indexes. There's a way for us to take the temperature of the performance of these stocks, and that's an index. Well, we can make a collection of index funds. So now we're creating a fund that we have access to make an investment in that's going to mimic this measurement that we're doing. A very broad-based common index is the S&P 500, the Standards & Poor's 500. It's the 500 top performing stocks in the stock market. Standard & Poor's is a company, an old company. I don't even know if they're still around. And so it's simply measuring what's this collection of the top 500 stocks in the United States market doing. It goes up and down. So they've created an index fund that mirrors that up and down. We have access to that. It's an ETF, an exchange-traded fund. Large companies that specialize in index funds. One in our neighborhood called Vanguard. Vanguard Group, nationally known. Jack Bogle was the founder of Vanguard. And that is, and we'll get into this conversation, an approach where the recommendation is just simply buy this generalized exposure to the stock market in sort of general areas, and that index over time, that performance will be great. It'll be fine. There's volatility associated to it. Again, any investment, there's volatility. But over time, just simply having performance numbers like the index will provide us with a very nice return experience. Our money will work for us over time very nicely. That is in competition with, in opposition of, what a mutual fund traditionally does, where there's a team or there's a manager. That's called active management, where somebody or a group of people are making researched decisions about which company stocks should be inside of this mutual fund package. When do we sell them? When do we buy them? How do we change this so that we're trying to have better performance than the index or the stock market in general? So there's a dynamic there. There's a give and take, a back and forth. Active management, people making decisions, versus passive management. We're simply mirroring the performance of the stock market in general, or just large companies, or just technology companies. So that's an index fund. Annuities. Annuities are a contract that you or we have with an insurance company, and they're a contract that, for us to give the annuity company our investment money, they will guarantee us something. Typically, broad strokes, big picture, if we give this insurance company investments, they will have this contract and they'll guarantee us that at some point in the future, typically around retirement time, if we go back to them and ask them, okay, we've achieved a certain age, we want you to generate this income for us for retirement, and that is a prearranged guarantee that the insurance company will provide that income for the rest of your life, typically. And so there's a balance between, well, does that make sense? Is that a good idea? Is that a good investment? Well, if you're going to live a long time, at some point, the amount of money that you gave that insurance company as they give it back to you will run out, but the insurance company has guaranteed you a payment for the rest of your life. So if you plan to live to 120, good idea having some sort of annuity contract. It can become complicated. It can get expensive. It's good to work with financial professionals and have this conversation in planning for retirement when you get into annuities. They have benefits. There are some things that they do very well, and there's also lots to be wary of. Again, it is a way of managing risks. In this case for annuities, investment risk, risk of death, the risk of not having assets that you can pass on to your heirs. So there's a place for it, but it's an important conversation to have. Next word we want to talk about, REITs. Real estate investment trusts. Not all of us are able to make investments in real estate by literally buying property. Whether that's an apartment building, a rental home, a baseball field, not all of us are in a position to participate in real estate at that level where I'm going to become a landlord and I'm putting money in and I'm going to own that building, that land, that piece of real estate. Well, there are opportunities for us to participate in real estate, again, similar to a mutual fund, but instead of company stocks being what's inside of this product, it's a collection and a various portfolio of real estate. And that could be investment properties, it could be apartment buildings, it also could be storage warehouses, it could be business buildings where corporations are, corporate buildings. Not all corporations own the buildings that they're inside of. There's these large real estate companies and they own, if you work in a corporate suburban real estate dynamic at a corporate building, somebody owns that. So real estate investment trusts are that opportunity for us to make investments in real estate without actually being a landlord. As we're sort of going down the list, it's becoming more and more sophisticated. Alternative investments, I'll touch on that briefly. Alternative investments, which is next week's topic. In the world of the stock market, stocks and bonds, mutual funds, this ETF stuff, that's in public markets. It's the stock exchange. It's New York City, or in Chicago when they're talking about commodities, and they show those pictures of all those people in the small room in a pit, and they're yelling at each other, and they've got color vests on, right? That's the public market. All of us can have access to that and make, if we want to, investments of our monies into whatever that vehicle or product is. Alternative investments are focused more on private investments, private markets. It's things, companies outside of being listed on a stock market. Having those public obligations of having your stock be publicly available. Well, there's an entire world of large, medium, and small private companies across the United States and across the world. To make investments with them, and there's way more private companies than public, by the way. Sidebar, public investments, public companies, there's about 3,200 public companies. Private companies in the United States, there's close to 3 million. So it's a much bigger, but it's harder to access, harder to gain access to those investments. So alternative investments, usually there's barriers of entry, levels of qualification for investors to participate in it, because the federal government's not necessarily involved in those alternative investments. Private markets, the SEC, the FINRA, they're not involved. These aren't subject to the same due diligence as public stocks, public bonds. So alternative investments, we'll get into that more next week. It'll be my teaser. And then the next two are types of qualified, non-qualified. What's that mean? Qualified money, qualified investments are types of investments where the government has set up the ability for that money that's invested in qualified investments to not pay taxes now. It's a delayed taxation investment. IRAs, your individual retirement account, your 401k accounts at work, various retirement-oriented accounts are, we call them qualified money, meaning that the money inside of these programs, the government recognizes and acknowledges we're going to delay taxing you on that until some point when you're retired and you start drawing money out of this to pay your expenses. That's when we'll come back to you. But from now until then, we're not going to tax you. That money is allowed to be in this investment, whatever that is, and grow as much as it does and up and down. And then we'll come back to you later when you start drawing assets, and then we'll tax you. The government's always going to figure out a way to get their taxes on the investments. It's just whether it's now, current, year to year, or later. Non-qualified is the opposite of that. Non-qualified is the money in your bank account right now, the money in your savings account, cash that we have in our pocket. That's all non-qualified money. If we were to make a non-qualified money investment and it grows each year, the IRS is going to ask us how much did it grow, and you owe us taxes on that. That's non-qualified investing. Transfer and rollover, two terms. When we refer to moving money around in a retirement package, in a money that's focused on retirement investment and growing your retirement amount of money, if we're moving that around from one bank to another or from your 401k to a new 401k, we're doing that through a rollover process where we get to communicate to the IRS, this is money for retirement and we moved it over here. We never took any of that money to spend and it all went over to this new place, and we've got evidence of that, and that's a rollover. The IRS reviews that, says, got it, good job, we're not taxing you on that money still. Right. Well, that's a lot of information. That's a lot of moving parts. And so if we were to start making a decision, I would like to buy a stock, okay, what does that mean? Well, if we want to do this properly and not simply throw darts at a list of stocks available, we need to start doing research for that. How is the stock performed? How is the company performed? What are the expectations for growth, for income? How have they done in the past? What have they done well in the past? What are their failures in the past? What are their expectations going forward? So this starts when we start to try to do some research. It gets overwhelming quickly. It's overwhelming for professionals, let alone people who don't do this every day. So what are your choices? Well, the choices turn into working with a financial professional, financial advisor. We used to be called stockbrokers. Some of us are still like that reference. Or working with full-service brokerage firms. What's a full-service brokerage firm? Those firms like Merrill Lynch, Wells Fargo, UBS, the large nationally known companies, historically they tend to be the most expensive to work with. We call it a full-service firm, so they are at the highest fees. But they also will position that as we have lots of services in addition to those fees. Then there's the discount brokerage firms that you can work with, and they're numerous. Edward Jones, Fisher Investments, the old E.F. Hutton for people who have gray hair. Discount brokers. So they're going to provide or offer less services for less costs. So there's that dynamic. And then there's online brokerage services that are available, and they're very large, some of them, very prominent. I mentioned Vanguard Group. Vanguard is an online brokerage. Another large, nationally well-known one is Fidelity. Sometimes there's no help. It's a do-it-yourself, but they're just providing a platform for you. Completely fine if you want to do it on your own. Goes back to my point of that's a lot of research to make good decisions. Or there might be some minor help. So it's important if you recognize, okay, I want to have someone I can talk to, some sounding board, some professional I can communicate with to help me along this journey. Well, before you do, there's a little prep work I would recommend that you do before that. Certainly ask friends and family, ask for recommendations, do some research on your own. If you have identified a financial professional, there's a way for you to do some research, some background research on this person. Are they actually licensed to give financial advice? Have they had a history of making bad or illegal recommendations and choices? You can go to a website that the government runs called brokercheck.org. Broker, B-R-O-K-E-R, check, C-H-E-C-K.org. And it is a national database. You can input your potential financial advisor's name and their city, and they'll come up with a report showing you, yes, this individual is licensed, this is when they got their initial licensing, this is how many various licenses they have. They will also show you, have they ever gotten in trouble for anything? When was that? Sometimes they'll even share with you what did they get in trouble for. Brokercheck.org. They probably also own brokercheck.com, but go to .org. So I would recommend that. Do your research, do your background check on that. If you've engaged with this individual, you've had these meetings, you've had this conversation, stay in touch with them. Continue the conversation, continue the dialogue, and then obviously not only review your investments regularly being once a year, don't look at it daily, you'll drive yourself crazy, but look at it regularly. Have a conversation with this financial professional regularly. If it's just about the investments, once a year we want to touch base, check in. What's going on, what changes, let's revisit, rebalance. If it's about more holistic, panoramic life financial planning, and there's goals and aspirations and setting up things, then that conversation takes more frequently. And real quick, let's talk about, I sort of set it up previously, that index fund passive investing versus active management. That's a good conversation to have, and there's goods and bad for that on both sides. Vanguard being the local 800-pound gorilla for passive investing. There's tried and true, strong believers, and we work with clients ourselves that will have maybe their 401k fund is left at Vanguard. We're okay with that. That's okay. Vanguard does a great job of being able to help you invest in a broad indexed funds where you're getting exposure to or have a diversified exposure to the stock market in general. That's a good thing. They do a good job, very competent, and there are also benefits to working with a financial advisor or a financial advisor team. So let's look at a couple more areas. So we get into what are the different types of accounts. Okay, I'm in, I want to invest, I may or may not be doing it myself, but how do I set this thing up? Like, I just don't throw money out the window. What do I do with this? So the different types of accounts. The individual is simply registered. The registration is how the account is titled, who owns this thing. Individual is your account. It's you've set up, you've established, you've verified, I am who I am, here's my social security number, here's my date of birth, here's where I live, here's my phone number. you've established, you've opened an individual account, whether it's with me or with Vanguard or a brokerage firm, whatever it is, you've opened an account and you can put money into it to invest. Joint account is typically you and your significant other. Doesn't have to be, but it can be. Transfer on death is a type of account. We call it TOD. It's you're building into the name of the account who will inherit this when I pass away. So it can be individual account, Christian Weirich, TOD, Mark Pinto, so that if it's communicated to the firm or the company, Christian passed away, it's a TOD account, Mark is the person that's going to receive this assets, we need to get in contact with Mark. 529, UTMAs and UGMAs, going right to left, Uniform Gift to Uniform Gift to Minors Act, and then the Uniform Transfer to Minors Act are types of accounts that you can establish when you have children under age of majority. And it was a way for us to put money away in investments for our kids or for kids or grandkids. And so it allows minors to eventually come into ownership of an investment portfolio. Okay? 529 plans, which is named after the legislation that established it, is a government structure designed for guardians or parents to invest money oriented towards helping college costs. So you've got a minor, you've got a kid, your grandkid, and you want to put money away for them to help them with college. That is a 529 plan. It originally was sort of defined, each state had their version of it. Over the years, it kind of doesn't matter which state is sponsoring this program. That being said, some states still do this. Pennsylvania does it. I don't remember the website off the top of my head, probably 529pa.org or something. And it allows for you to establish an account that you're putting money into. You can put money into it systematically, monthly, which is what I've done with my children. And when they're of college, going off to college, this account has had money invested in it. It has not paid taxes. The government has allowed for this money to grow without paying taxes every year. And now we can use this money to pay for college expenses. So that's been a great way for lots and lots of people to save their money. There are caps on them. I don't remember the caps off the top of my head, but it's a funding vehicle for college expenses. Great thing. IRA, thank you, pa529.com. IRAs, individual retirement accounts. This is what we all establish to help us put money away systematically for our retirement years when we stop working. And that's the concept. There used to be a time in this country where you would get hired by a job, you'd be working for a company, an organization, and they would establish for you a pension. And that pension would be a guarantee of income for when you retire. If you're part of a union, you probably still have pensions that are established, but they're, over the last 30 years, have been a type of retirement funding vehicle that were obligated for the company to maintain, and companies figured out, well, that gets expensive. We're going to shift that responsibility over to you, and so we're not doing pensions anymore. Some companies do 401k plans. I'll touch on that in a second. But it really did shift to, it's now our responsibility for us to invest for our retirements. And we do that through an IRA. A couple years ago, they modified that, a Roth IRA. Again, it goes back to when does the IRS collect their taxes? Traditional IRA, money goes in, it grows, no taxation, money comes out at the end, IRS gets their taxes. Roth IRA, a new version, whatever money is going in, you're paying taxes up front, it grows. Whatever that growth is and you start taking it out, you don't pay taxes. So in simplest forms, traditional IRA, you're going to pay taxes later when you retire. Roth IRA, taxes are paid for up front, and then that money grows and you get that money later, no taxes. It's a simple explanation. SEP and simple IRAs for self-employed individuals. Self-employed plan is what SEP stands for. So if you're not part of a company, you're out being an entrepreneur, you're out on your own, but you need to save for retirement, that's accommodated through a SEP or a simple plan. And then 401ks. 401ks are the new pensions. It is corporate America shifting responsibility for planning for your retirement to you. You are in charge of your 401k through your company, and there's recommendations I'll make for that for you, for your company, but it is your responsibility to be in charge of. There's an opportunity for me to invest, take money out of my paycheck, put it into this 401k program, and I have access to some array of investments, right? You get a menu, and you're responsible for knowing, oh, this is how I need to invest my money and have a diversification so that over time my 401k retirement money will grow, and depending on how much time you have, that you basically are able to have a willingness to have more exposure to risk, the more volatile stuff, the stuff that grows really big over time, because you have more time. Or I'm in my mid-50s, maybe I want to have some mixture of really stuff that grows and then some stuff that's more income oriented because I'm getting closer to retirement. So if the big risky stuff has a bad time and it really drops off the table, which we've seen, which the stock market does, it's cyclical, that's natural, well then maybe I don't want to time that and have a bad experience. So 401ks. 401ks, supersizing tips. One, if you have access to a 401k from an employer, take full advantage of the employer matching, right? Just about every 401k plan, when your company offers it to you, there's some level of, we will match you dollar for up to something. We'll match you dollar for dollar up to 3% or up to 6%. So the first 6% you put into this 401k will match you dollar for dollar. Do that. That is free money. Your company is offering you free money by saying they'll match you dollar for dollar up to something. Whatever that percentage is, do at least that. If you're in a tough spot, a tight, your budget's tight, figure out a way to have at least the max matching in your company 401k. That's the minimum that you have to do that. Because again, if I haven't said it already, it's free money. Second, how to supersize your 401k would be the next level. Figure out if you can, and get yourself to a point through financial discipline to maximize your contributions to the 401k. That's right now somewhere around $18,000 a year. And if you're over 50, like many of us, you get to sock away a catch-up contribution, which is an additional $6,000. So if you're of a certain age and you're able to, with your budget, you can maximize yearly contributions in your 401k of up to $24,000. That's a good thing. That's how you supersize your 401k. And then again, the biggest tip, the most important factor about investing is time in the market. How much time in the market you have is sort of the best determinant of how successful you will be. It is not timing the market. We're not trying to guess. We're not trying to figure out, I want to get in, I want to get out, I want to get back in. That is a recipe to make yourself have a terrible experience. There are numerous studies that prove again and again and again that as humans, we're subject to emotions and we make terrible decisions about the stock market if we're left to our own devices and we make emotional decisions. Don't do it. Time in the market. Get in, stay in, be patient. And with your 401k, as you have it, reevaluate, review, and rebalance. Again, once a year, go back to your 401k, check it out, check in on it. How's it doing? What are the changes? Has some of your investments had a really good year and some of them have struggled? That goes back to the old buy low, sell high. If something's had a really good year and something else in your portfolio has had a not such a great year, rebalance your 401k. Have the stuff that's had a really good year, sell some of that, reallocate it back to the stuff that's struggled a bit, and keep that, whatever that balanced mix is that you've decided on. 50-50 between stocks and bonds, 60-40, 70-30, 80-20. Maybe you're all stocks because you're younger. Great. Still rebalance. If you change jobs, the recommendation I would recommend, figure out and pay attention and roll over as soon as you can. Just about all 401k plans allow for, you're in an old job, you had their 401k plan, you're here now, we've got a 401k plan, go get that old 401k plan, roll it over into your new 401k plan. They may not mix them together, but it's important for you because all of your 401k money now is in the same spot, and you start your contributions again. Okay, so roll over if you move. And the other rule of thumb I'll share with you is resist the temptation to borrow against your 401k. Budgeting can be very difficult. We all go through financial challenges. Resist the temptation to borrow against your 401k. They allow for it, you can, but ultimately the 401k is for your retirement plan when you're much older. Let's talk about some of these questions. How do we decide what's right for you? Well, we can have these conversations, and again, it gets into working with a financial professional and the level of engagement you're having with this financial professional. Am I simply looking for a vehicle for me to help facilitate these investments? That's okay, that's fine. But when you engage with a financial advisor, a financial service professional, we want to have these conversations. What is important about money to you? And that's a much deeper question. There's obviously, oh, I want my money to make money for me, right? I work hard, I want my money to work hard for me too. Okay, that's one level. But what's important about that? Okay, well, let's think about that. What's that mean? And everybody's answer to that question is going to be different. I was working with one gentleman, and I asked the question, well, what's important about money to you? And he said, well, I want more of it. Okay, fair, good, fair answer, but why? What's important about that? And he thought about it and reflected a bit, and then he said, well, freedom. Oh, that's interesting. Tell me more about that. Well, what does that mean to you, freedom? And so we had this conversation where it was just asking the question, tell me more. What's that mean? Well, what's that mean to you? And what it means ultimately, when he sort of went 3 or 4 questions in, was when he was growing up, his parents struggled financially, money was scarce, it was hard, that impacted him, and now as a grown-up, as an adult, having financial security will allow him to not only feel safe, but also, by his definition, freedom is, I know I can go do whatever I want whenever I want. No one is in charge of me. Okay, that's important to know. That's an important answer. And that's a deeper answer than, I just want more money. So that's important. What's important about money to you? What do you want your money to do for you? And that gets into goals. What's your goal for this money? And we covered some of that last week in budgeting. What's this money supposed to do? You know, this slice goes towards paying the rent or the mortgage. This slice goes towards paying the light bill. When we get into investments, it's a similar approach. How are we budgeting our investments? This money is going towards my retirement plan. I'm going to retire at 75. I've got 20 plus years to have this money work for me. I can invest it in something I know is going to be volatile. I know it's going to go up and down, but ultimately it's going to end up more than where I start. Okay, great. That's different than how we want to invest money that's dedicated towards buying our beach house. I'm going to buy a beach house in 10 years. I'm going to invest some money so that it grows, but that's a different strategy. There's different risks involved in that. It's different timing. We want to make those educated guesses and to plan appropriately. How much risk can you tolerate for each of those goals? If my goal is in 3 years, I want to invest money because I'm going on a trip to Paris, that is different than I'm investing money for my retirement. 3 years I'm going to Paris. Well, how I invest that money, what I don't need it to do is the stock market has a correction in 2.5 years and dramatically goes down, and I'm invested in all stocks, and I have all of a sudden less money for my Paris trip, right? So what's the goal for these investment budgeted monies? And then it goes back to that question, how much do I want to manage for myself? Investing is complicated. There's a lot of moving parts. There's a lot of language. There's a lot of sophisticated ways for you to make these allocation decisions. And it is complex, it is deep. Not only is there an ability to buy a stock, but there's 10 different ways to buy that stock. You can buy that stock as an option, as just a straight up buy, as a limit order, as a market order, as a stop order. It gets deep fast. So do you want to do that yourself? Or do you want to enlist a professional to help you with this? So let's touch on this topic, retirement planning. Okay, retirement planning. Here's the important questions. Who should be planning? Well, the short answer, as you can guess, all of us. All of us should be retirement planning. It's important. Everybody should be planning. And conversations with professionals regularly can go a long way to make sure that we stay on course for this retirement planning, right? Sometimes the market, the cable news shows, the talking heads, your feed in your phone, there's a hiccup in the market, there's a correction in the market, all of a sudden it feels like, uh-oh, is this when the whole market just fails? Is this the end? Well, the answer to that question is no, it's not, but it's going to feel uncomfortable. Okay, working with a professional goes a long way to help me stay on target. Balancing retirement planning with other financial goals, it goes back to that budgeting, right? We talked about budget for your income and your household. Similar conversation with investments, budgeting for investments. Retirement planning, that shore house, that trip to Paris, a new car, planning for education, college costs for my kids or my grandkids. It's a planning conversation. Let's get into this other topic, investment basic principles. I've got some beliefs about investing in the market and some tried and true experiences. Like I said earlier, it's time in the market, not timing the market. There are study after study, empirical evidence that the stock market over the past 206 years, Jeremy Siegel at the University of Pennsylvania's famous and renowned economics professor at UPenn did this study. Stocks historically return about 6 to 7% above inflation. That is not a guaranteed number, nor is that a linear graph, right? So it gives us a guide, and there is volatility. We're making investments. All investments have risks. It's just the level of risk and our amount of time to handle that risk. The more time we have, the more we can get through the volatile times, right? I know the stock market will always be higher later than it is now. The trick is that to get to that higher number, it will most likely be a bumpy ride, and it will feel uncomfortable. But I know in time, over the long run, it will be higher, right? Just on any particular day, no one knows. Equities, stocks, they will perform better than bonds. Not every day, but again, long term, equities will outperform bonds, but it's time. How much time do we have? How patient are we? Volatility is not loss. That's a thing to remember. The cable channels blow up, people are screaming at each other, someone's throwing a pencil at somebody, stocks are down, this stock is down, that company's in trouble, panic, everybody panic. No, volatility is not loss. If you are down and you don't sell, you have not realized that loss. Stocks will recover, right? Patience. We feel as human beings the significance of loss greater than we enjoy the gains. So be aware of that. Behavioral finance is a thing. It is an area of study. It is important to know about yourself. Again, what's important about money to you? What's that mean? Do a little self-assessment. Volatility is not loss. Diversification, again, have a plan. Diversification, having a broad array, an exposure to multiple areas, multiple companies will help that volatile experience be smoother, not smooth, but smoother by having diversification. And probably the big secret of the universe, as Albert Einstein labeled it, compound interest. Again, compound interest, one of the most powerful forces in the universe. Over time, the ability for your dollar to turn into $2 and $2 to turn into $4, that is why we do this investment, right? Compound interest. And the rule of 72, for those of you that aren't aware of this, one of the sort of back of the envelope guides that we have, it's called the rule of 72. Whatever your performance is in this, or projected performance of this investment, last year my stock investment returned, it grew by 7%. Okay, I take that number, I divide it into the number 72, and that result tells me how many years it will take me for my money to double. Okay, so in my example, I got a 7% positive experience last year. Okay, 7 into 72 is 10. So I know that if I get 7% every year, my money will double every 10 years. If I get 3.5%, it doubles in 20 years. If I get 14% return, it doubles in 5. That's the rule of 72. It's a tip for you to, as you're looking at all these numbers, to keep in mind, expectations. So here's a QR code that we offer up. One of the services that we provide with our clients that we work with is a risk analysis. It's a questionnaire that we do that you can get through pretty quickly, and it allows us to share with you, based on your answers to some of these questions, what your risk tolerance is. Am I someone that is able to stomach some volatility, some larger risks, and over time I know that I can invest? Or am I someone that my relationship with money is such that I don't like money going down. I don't ever like my investments to go down. So how I invest my money is going to be impacted by that. So that's our conversation tonight. I appreciate everybody listening. If you're still there, if there's any other additional questions, feel free to type them into the chat.
Or they can unmute, right?
Or they can unmute.
Yeah.
Yeah, we're all friends here now.
Anyone have anything?
I'm interested, this is Lucy speaking, I'm
Hi, Lucy.
interested in the annuities aspect of it. You did mention that there are pros and cons into these annuities. And I guess the cons are the fees associated with it. My brief understanding is that it's normally offered by insurance companies, and they're betting you're going to die before they finish paying you.
Yes. Yes, that's a good summary, Lucy. Yeah, so annuities, like we talked about, yes, it's a contract offered by insurance companies. What are some of the large insurance companies that we're aware of? Well, there's a local one, Lincoln Financial. Lincoln is a very broad array of various annuities that they offer. Nationwide, Prudential, Pacific Life, that's the commercials with the whales jumping out of the water. So there are lots of annuity companies, and they offer these contracts, these annuity contracts. And you're right, the idea is, what are you looking for? You're looking for some protection, some retirement income in some of these, or some contract that allows for when I do pass away, and so far all of us have passed away who have been born so far, and all of us alive at the moment will eventually pass away. We haven't found anyone that's figured that out yet. Well, can I leave something for my heirs, or can I have a guaranteed income in retirement? And so there are annuity contracts that are designed to answer those questions. Great, wonderful. That being said, annuities are contracts offered by insurance companies. Insurance companies are here to make a profit. Insurance companies are not nonprofit organizations. So, to your point, Lucy, yes, be aware of the fees involved. Be aware of another fee is an expense ratio. So we're going to build this contract, we're going to offer this product, and inside of this product is some collection of investments or a basket of types of investments. And we'll have there's an annuity structure out there that's designed to participate in the stock market, but they'll protect you on the downside, and for that it costs money, right? You're paying a fee inside your annuity so that you can participate in the stock market to go up. You're getting some protection on the downside, so if it's -5, the annuity company might say to you, you're flat, no negative experience for you. And then when I retire, I want that guaranteed income, and an insurance company promises, we will send you a guaranteed income, and they'll clarify with you how much that is. But they're betting on most people are going to die around a certain age, and that gets into actuaries and actuary tables and the math of life, and the benefit, the real benefit for those of us that have long life is that at some point this money that we gave to the insurance company to have this contract, this guarantee, they're paying that out to us. That runs out. They're no longer making money on us. They can't charge us any fees, but they guaranteed that they would give us that payment, and that payment lasts until I die. Or sometimes they structure that my partner and I, and it will last until the second of us passes away. Great. So annuities can serve a purpose. There can be some really important help that annuities provide in retirement planning, estate planning, leaving a legacy. And we do want to be aware of how much is this going to cost us. And so is it appropriate? Is it expensive? Be aware of that. Insurance companies got in big trouble 10, 15 years ago because they were really expensive and no one really talked about it. And then finally, the public and the government were like, wait a minute, I don't know if you're delivering on the value versus what you're charging these people. The annuities today, the last 10 to 5 years, insurance companies are becoming much more fee conscious. So there are some products that they may not charge you to get into them, but you'll have to hold those contracts for a minimum of 7 or 9 years, which if you're holding it for retirement, you would do anyway. So there are, again, lots of options. It gets complex quick. Annuities are just sort of next level investment strategies. So be aware of those fees, but working with a good professional can help navigate what's appropriate, what's useful, and what would be meaningful for you. I'm over my time.
Lucy, you're the only one left. Any other questions?
Well, actually, who would be a good candidate for an annuity? Like, what type of person does this particular product suit better?
Yeah, so insurance companies will say it's for anyone from 30 to 80. We would sort of put a parameter on annuities are good for either planning for retirement and we're trying to handle some of the risks involved in investing and put in some guarantees about income in retirement. So someone in their 60s and 70s might be looking for a version that is more, hey, I'm going to start asking it to give me some income soon. There are other versions for people in their 50s that are geared more towards, okay, you're going to put money into this investment and you're going to let it grow and we're not going to touch it for 20 years, 25 years. And then later, we'll ask it to send us some retirement income. So it varies, and of course, insurance companies have all sorts of various products available. But I think annuity planning as, hey, I want to use one of these, most of the time we're talking with clients in their 60s or their early 70s. Their insurance companies are willing to write insurance policies or annuity contracts, usually up to people that reach about age 80. After that, the insurance companies say, no, we're not doing that anymore.
Okay.
Okay, thank you very much. That helps.
Absolutely. Thanks. Have a great evening.
All right. Thank you.
Okay, you too as well. Thank you.
Thanks, Christian. See you next week.
See you next week.